The broadcast is now starting. All attendees are in listen-only mode.
Good morning and welcome to the latest in the IMAP webinar series. It's a pleasure for us today to have Paul O'Connor from Netwealth, the Head of Investment Management and Research at Netwealth, presenting on the way we got to where we are now with managed accounts and the way in which managed accounts are going to develop from here. I'll introduce Paul in just a moment. But for those of you who are attending, and welcome to those who've joined in so far, you'll be able to key in questions on a panel which you see on your screen. We'll be dealing with the questions at the end of the session. But before I hand over to Paul, what I'd like to do is introduce you to one particular event which IMAP is in the process of now organising, and that's the Managed Account Awards. So on the 1st of August this year, IMAP will be holding the first Managed Account Awards event. And the objective of the awards is to recognise best practice in managed accounts. Our recent fund census for December 2017 showed that managed accounts are now nearly $60 billion of investor assets, and that's as a proportion of platform assets of about 820 billion. So clearly, managed accounts are becoming a very significant part of the advice process. And at IMAP, we want to recognise what best practice looks like. To do that, we've assembled a panel of independent research consultants, people who've got experience in acting as chairs or participants in investment committees for dealer groups, and have the support of Financial Express as our data partner for the Managed Account Awards. So Angela, Nigel, Brad, and Dominic McCormick are participants in the panel, as is Mark Oliver from Macquarie, who brings an SMA view to the adjudication and the assessment of managed accounts capability. The categories which we are involving are a number of investment-only classes, so Australian equities, small cap, international equities, multi-asset class, and fixed income. And so this is, if you like, the conventional place in which SMAs and MBA portfolios have been offered. But in addition, and just as importantly, we're also offering an award for the licensee approach to operating managed accounts. And those of you who are involved with dealer groups, or those of you who are advisors, those of you who are researchers, those of you who are working in licensees, I'd encourage you to participate in particularly the AFSL class. So this is where we try to move our assessment to one which considers how a licensee's advice philosophy and their investment approach is both expressed in their advice process and in the portfolios that they offer through managed accounts to support that investment philosophy. So we're looking for a lot of qualitative issues in the AFSL class. This is really a way of saying, how does an advice business manage to reflect its advice philosophy, its investment philosophy in the managed account portfolios? And the final category is an innovation class. So that invites you to put up a wide range of managed account innovations, and I've had a number of people talking to me about their approach, and they really are quite different. This is really looking for those things which which are new and are likely to improve the way in which managed accounts meet individual investors' needs. One of the questions I've had about the licensee portfolios is our expectations, for example, of benchmarks or goals. So we're looking for advice businesses, for example, who've got a goals-based approach, or those who've got a risk-based approach, those who have absolute return-based approaches. We want to see how an investment philosophy, which has previously been expressed in that way, can be articulated through a managed account portfolio. Here's a little on the timing. So entries by the 31st of May through June and July will be, the judging panel will be doing the adjudication, and then the awards event in Sydney on the 1st of August. So I'd encourage you, if you're proud of what you do in a managed account, in your managed account areas, if you're a portfolio manager or an investment manager or a licensee, I'd encourage you to take part and to join us in helping to promote the use and development of managed accounts. The entry details are available on IMAP's website, and that's showing on the screen here. So now let me introduce Paul O'Connor. Paul's the head of investment management and research at Netwealth, and has over 24 years experience in financial services. He's been with Netwealth for nearly 5 years from Challenger, where he's key account manager for research and consultants. So Paul is holds the CIMA designation and is a participant in MCAP. So look, let me hand over now to Paul O'Connor from Netwealth to take us through a view of the development of managed accounts to this point and where we're going to see managed accounts develop in future. Paul, over to you.
Thank you, Toby. Thanks for the introduction there. And yeah, I guess over the next 30 minutes or so, I'll just run through a presentation really talking about the past, the whole background behind managed accounts, where they came from, the present of what we're seeing at the moment in the marketplace, and also, I guess, some insights into the future of managed accounts. So it's really talking through the experience that Netwealth has had as a business in almost 4 years now since we've operated the managed accounts. And I guess it's really, the focus is very much on how advice businesses are now using managed accounts and how that has evolved over the period there. So in terms of the past there, it's probably just worth making the comment there that I recall probably in the early 2000s going to a number of conferences in Sydney on managed accounts, and funnily enough, the MC or the organiser of those conferences was none other than Toby Potter. So Toby, I certainly see you as inextricably linked to the past with managed accounts, but not only the past, the present as well, and I'm looking forward to continuing your association into the future on managed accounts there. So in terms of the whole managed account journey, I mean, the origin of managed accounts essentially started in the late 1980s, early 1990s in the US amongst the higher advisory groups there. And I guess they were looking at ways at more efficiently running their US equity biased portfolios for their clients, and being able to provide, I guess, more consolidated tax reporting, a more consistent outcome for their clients. So that was sort of the genesis about the starting point of the managed account. I think what we saw then over the next sort of 15 to 20 years was that it really was very resource intensive. So the early managed account providers effectively were entering trades and line items for each investor, each client, into a spreadsheet on a line-by-line basis there. So it was really a case of understanding the benefits that this investment vehicle had to offer, but balancing that with scalability. And ultimately, what has driven it there is technology. and the growth of technology, being able to offer a managed account service that can be customised and used by masses for many different types of portfolios. So Netwealth, probably a little over 4 years ago, started to develop the offering in the marketplace. I think it's probably a little over 3 years now that we've actually had our service in the market there. And when we launched back in 2015, Morgan Stanley had the Morgan Stanley Asia Insight report had estimated that the total funds invested into managed accounts in Australia was about 12 billion, and that roughly about 18% of the advisors in Australia were using managed accounts. So, and a large portion of those advisors would have just been using it very much at the edges and not a core part of their value proposition. And really, there were just a handful of platforms in the market that actually offered a managed account service there, and typically the ones that were doing so were offering that as an adjunct service to the platform. So it was not integrated into the full administration service of the platform. So really what we've seen over just the last 4 years has been a phenomenal growth across the amount of platforms offering and the amount of advisors using it. I think I'll just by way of phrasing, I find it sort of useful in these conversations just to set a couple of broad definitions around all the terminology that's thrown around in this space. So when we refer to managed accounts, my view is that it is a professional investment program that is actually purchasing underlying assets at the time of investment for the investor. So it is not going into a pooled structure. In terms of undermanaged accounts, there are a number of different ways that this can be offered. It can be offered through a managed discretionary account, an MDA. That's obviously the licensing is at the onus of the advisor, or it can be offered through an SMA structure, a separately managed account, which typically is offered through a managed investment scheme structure by the platforms in the market. But I will also add that there is also the ability to offer an SMA through an ASIC class order as well. So there's probably 3 different regulatory structures in which managed accounts will be offered. For the purpose of the presentation, I'll focus mainly on the SMA route and how that is offered through a managed investment scheme structure with a responsible entity there. So, the present. I think as we're all aware, every day we open up the financial news and there would be at least one article we see about managed accounts, about the growth of managed accounts, about the development in terms of the amount of managers now offering and wanting to offer managed account strategies, about the increasing number of advice groups taking on those strategies. So if you fast forward the 4 years from when Netwealth commenced the journey, the market of about 12 billion has grown to in excess of 50 billion today, according to IMAP figures there. So that's been a phenomenal growth if you think about it over the last 3.5 years there. But really, I guess it's really scratching the surface at the moment, because it's estimated that the 50 billion is circa 7% of total platform assets. So if you think about it, managed accounts and the growth of managed accounts, I think, will continue over the medium to longer term there, as we've only really scratched the surface of the market where it can be applicable to use. We're seeing more and more IFAs rapidly adopting the managed accounts, and not, surprisingly, we're seeing a response from the platforms, from the new independent platforms, from the older, larger wealth management group platforms, to really rush and prioritise the development of a managed account service for their clients there. So I think moving on to the next slide there. Netwealth released an advice tech report in 2018, and it was quite interesting there, where it's estimating as of today that almost 40% of advisors are now using a managed account in some manner, shape or form, whether that's through, again, the MDA or the SMA structure. Around 40% of the market are using it. My feeling would be that, maybe 15 to 20% are using it now as a core part of their investment value proposition. So the other 20% would be just more recent entrants into using this service. From surveying the marketplace, though, we believe that that will grow by about another 21% over the next 2 years. So I think, again, that shows you that if we're correct in this, in a couple of years' time, we're looking at over 60% of the advice market using managed accounts. So that, if you think about it, will have a profound effect on the advisory groups and how an investment value proposition is offered to your clients. It will have a large impact on platforms and the administration services that they are offering, and will also have an impact, obviously, on fund managers, who the traditional distribution model for their products would be through a pooled unit trust, through a managed fund. But they now also need to think about a different way of packaging up and selling their IP into the managed account market. Moving on, the evolution, to continue the comment, I guess when we first launched our managed account and we built the service, and I think this is not dissimilar to the managed account providers in Australia over the last 10 years, the services started as of trying to offer SMAs that could efficiently run direct asset portfolios, and specifically Australian equities, so direct Australian equities. So most of the managed accounts were built out along those lines there, and whether they were running it through an SMA structure, or whether some of the more traditional stockbroking firms were starting to use an MDA structure to run more regimented investment programs for their investors. That was the genesis of it, and particularly if you think about the first managed account products offered in Australia, and I think back to the early 2000s where we had one in the marketplace, it was all about direct equity offerings. If you fast forward on to where we are at today, we believe that the largest demand by far in the marketplace is for a private label managed account. So really what I mean by that, it is about a licensee, a financial advice group, using a number of SMAs to efficiently run their investment portfolios for their clients. And really, I think that is where we've been moving further and further. That is where the real demand is in the marketplace. And that's where we're finding that we're further developing and improving our product to bring more services, to bring more reporting, to bring more features, so that fully diversified model portfolios can be run within an SMA structure. In terms of the private labels, so the private advice groups using a managed account structure to effectively implement their model portfolios, so that is what I mean now by private label managed accounts. It's really not just a bespoke part of the investment advice. It is part of a whole business value proposition, and it will transform a financial advice business in a number of different areas. So if you think about the advice process, if an advice group is currently running a set of model portfolios, conservative through to, say, high growth, there's a need for personalised advice, the need for ROAs, the need for the interaction with the client to get the approval to implement a rebalancing in a model portfolio, to switch a managed fund or a security in a portfolio. So a managed account, for starters, will do it all instantaneously for all of the clients. So certainly one of the key feedbacks we have had from private wealth groups using our managed account service is that it is very much treating our clients equitably. So instead of the first client getting a model portfolio rebalance or a switch out of one managed fund into the other in January, and then the last client having the switch completed in June or July, it would all be done instantaneously. So there is that equitable benefit for it in the advice process. There's obviously the potential tax benefits there too, because as I mentioned earlier, a managed account is simply buying the assets in the investor's name on the day they invest. So there's no inherent unrealized capital gains, which is what you can actually encounter when you're using a pooled trust or a managed fund. From the customer's viewpoint, then, not only are they getting the tax benefit there, but they're getting far greater transparency into the underlying assets held within their portfolio. And then that also changes the nature of the communication and education piece, that in terms of the interaction with the client. And I guess one of our early experiences in this space was that when we released a number of Australian equities SMAs in the market, I think there was Dalton Nickel Reed, there was Rolton. Early on, with all the underlying changes and trading in stocks, the communication from the manager then moves from a monthly report around how a fund has performed to more ongoing dialogue as to why, for example, Rio Tinto has been sold and Wesfarmers has been purchased. So it does change that nature of the communication there. And again, I deal a lot with the managers about supporting the underlying users of your SMAs and really bringing to life that transparency around the changes in a model and why they have changed. In terms of investment management, it's really about automation of a model portfolio for most of the groups we have been dealing with. So it's really about how do they run those portfolios far more efficiently. But then it also allows, I guess, for a more bespoke number of portfolios that can be managed and offered by an advice group. And I'll get into that in a little bit more detail later. But it's, for example, just thinking something as simple as now being able to run an accumulation style portfolio and a retiree or an income biased portfolio. Also from the investment management though, it does put some onus and obligations on whoever the manager is to have proper governance in place, to have an appropriate investment committee in place with the appropriate skill sets that would be required to run that model. Again, I'll go into a bit more detail around that later in the presentation. And then finally, the last piece of the Venn diagram I think we have here is the increasing platform investment functionality. So it's really about then tailoring with a platform to ensure that you can articulate your value proposition, your investment philosophy as cleanly and effectively as possible. It's about having a scalable solution. Back to my earlier comments about the whole growth of the industry in it. It sort of commenced running managed accounts on spreadsheets, which was extremely resource intensive. And then it's also about client engagement, where again, our experience is that our IT development team here, of which we have a large number of staff in our IT department, I would think 50% of their focus of the time and effort of 70 odd staff is around producing better reporting through to the clients, better performance reporting, interacting with managers around corporate actions, etc. there. So it's the technology piece is also crucial to it. So if I just walk through briefly an experience that we've had about a client recently who has come on board and started to run their portfolios through our managed account service. We're talking about a fairly large financial planning business, around 1.4 billion in funds under advice and 7,000 plus clients. Their services are very broad: investment management, personalised advice, business, personal taxes, corporate advisory, mortgage broking, etc. So as they were growing, they really recognised the need to develop their systems and processes and how can they actually establish efficiency in their business and give the client a better experience. So their real challenges were that, again, under the old model portfolios, they required personalised advice. So again, that is very time consuming from an advisor's viewpoint and really caps, I guess, the efficiency and the number of clients that a number of these advisors can physically service over a 12-month period. The portfolio administration is time consuming, and I think some of the feedback was getting more and more time consuming, particularly if you are trying to run a more active asset allocation framework. There was a lack of consistency in the delivery of that investment philosophy to the client, and also a lack of consistency in the portfolio returns. And as I've sort of alluded to, there was that real struggle to actually efficiently implement a dynamic asset allocation framework. And I think as we've seen a huge take up in dynamic asset allocation and potentially aligning it more to a goals-based objective that Toby alluded to earlier. So that is another area where the managed account, I think, provided a solution. Ultimately, all of these issues were causing back office inefficiencies due to the compliance requirements, the client servicing requirements, and really limited the scalability of their advice. So the solution, they implemented their model portfolios through our managed account service. They actually implemented 3 different sets of model portfolios. So they managed to then segment their clients appropriately by offering a set of portfolios, a more cheaper set available for accumulators, a more full service type of portfolios for their retirees and their pre-retiree client base. And really, I think the first sort of feedback was that all of their clients started to get a very consistent return because they were all basically holding the same portfolio, they were all trading at the same time. The additional benefit was that the advisor could then start to focus on issues like tax outcomes. So again, this advice group had a number of their client base that were ultra high net worth, and they had, for example, potential employee share plans where they could not divest of shares, and let's just say one of the top 4 Australian banks. In running a managed account, they could actually put holds and put blocks on the stock so that they could actually hold out the sale of a share until the following financial year. So they started to be able to give the client a richer tax outcome. It certainly allowed a more consistent delivery of their philosophy, more efficiently implementation of their asset allocation, and timely switches. The IMA tailoring functionality, as I mentioned, that is more about blocking a trade for a tax benefit, potentially blocking the purchase of a stock because a client may already work for that organisation and have significant exposure to the equity of the organisation. It provided the back office efficiency that the advice group needed to actually make their advisors far more efficient and bring more scalability into their business. And I think on that, I was astounded that I heard one group make the comment that they thought or estimated that the move from a model portfolio structure to implementing it through a managed account structure saved their advisors around 12 hours per week, which, if you think about it, is extremely significant. The last benefit there, obviously, too, is the ability to, I guess, negotiate rebates with managers. So if you are running a managed account and you are looking at a potential manager, whether it's a managed fund or whether it's including an SMA in that portfolio, you will have a good idea of the exact dollar amount that that manager can potentially win. And managers and fund managers will talk discounts based on the size of the funds under management. So we are seeing more and more of that in the marketplace. So the clients ended up with a more scalable solution, consistent solution, and also ended up better off from a fee perspective. So in terms of the future and where we're actually going with this, I think ultimately the continued growth of the market will put more and more pressures on both the increasing sophistication of managed account services and the ability for customization. Really, I guess these two points will very much be dependent on the technology investment made by the platform. it is going to be not only a case of a platform releasing a managed account, it's about releasing it and then spending a lot of R&D ongoing to continually improve the service, continually improve the experience for the client, and further features so that more and more customized portfolios can be built. Certainly from our experience is that everyone in the marketplace has slightly different portfolios and slightly different needs from an administration perspective. And that's very much, I guess, our focus is in terms of prioritising the feedback from clients and continuing to build out sophistication and customisation. In terms of the asset classes, I touched on Australian equities large cap with the past. The present, I think, as we're probably aware, large range of Australian equity strategies now are available in SMAs. International equities are offered by a couple of the platforms in the market. Australian fixed interest, mainly listed income, managed funds, any number of managed funds. Our complete menu that we have on our platform is available to our model managers or our SMA managers, and cash options. The future, I think we're just going to see more and more, I guess, granular type of strategies. We'll see regional and sector global equity strategies. We'll see infrastructure. We'll see G-REITs. We'll see the increasing growth of the managed fund universe. Australian direct bonds. We have just started administering over-the-counter bonds, and we're seeing an increasing number of advisory groups talking to us about that. Responsible investing in ESG, so investment strategy overlays. We're seeing the embracing and more illiquid type of assets now being used in different SMAs or diversified managed models. And finally, their derivatives. There's a number of different investment groups I have been talking with, and they're looking at providing solutions, one-stop solutions, where you could actually very efficiently and cost-efficiently implement currency hedging into your portfolio. There are different, vehicles in the market at the moment currently where you can short the market. There are ETFs, etc. We will see more and more development in the ability to actually put shorts and use derivative structures around portfolios as well. So really, I think that's all leading to this increasing and more specialist type of portfolios. We're certainly seeing with a number of our clients that are running diversified model portfolios in a managed account structure, we're seeing, I guess, a number that traditionally were just only using managed funds are now starting to consider, well, maybe I will use an Australian equity SMA instead of my 2 or 3 different Australian equity managers. So it's really a case of now trying to, I guess, put their toe in the water to introduce more direct assets into their clients' portfolios. But with that then becomes the opportunity for the tax efficiency, the opportunity to lower the turnover in a portfolio, and naturally to lower transaction costs. We're also seeing model portfolios more closely aligned to that value proposition. How are you running? What is the attitude to beta or passive in portfolios? What's the attitude to the asset allocation? Strategic asset allocation, tactical asset allocation, dynamic asset allocation, the accumulator versus income portfolios that I mentioned earlier, that a couple of our clients are now running. And tax-focused portfolios. So particularly with direct equities, the advisor in hand with the investment manager can really go about being far more focused on tax and an efficient tax outcome for the client. And at the end of the day, a number of the clients are talking about using the different numbers of managed accounts, managed models, to really target how they address sequencing risk and longevity risk. So they are just a few observations about the different portfolios we're seeing. This slide really now the enhanced reporting and fee management. In terms of advice fees, it's quite interesting there that in terms of a model and a model manager, private wealth groups can in certain circumstances be entitled to charge a fee. And typically that fee will be embedded into the SMA fee there. And I guess a number of clients have moved to embed their advice and their investment management fee into that model fee. And then on the other side of the coin, we have had a number of clients say that we charge, our clients 1% a year for their funds under advice for advice. So we don't want to charge any fee on the model. So we've seen a need for Netwealth to offer a very much bespoke infrastructure as to the way that model fees are run. We're seeing performance fees now come in. We can administer performance fees now. Again, that was because a number of the underlying SMA managers that were being employed to run Australian equities and international equities were saying, right, we're happy to do it at a lower MER, but with a performance fee. So again, it forced us to build our performance fees. Then on the model fees, really, I guess when you're using a model portfolio and you're implementing them into a managed account, you can have a number of different parties involved. You could have an asset consultant assisting you. You could have an asset allocation expert. You could be using a Rolton SMA, and the model manager could be charging a fee. So we have a number of models where there could be up to a fee split of 70 bips going to 4 different parties. And again, it's about the technology provider being able to continue to update and further enhance the platform to be able to meet the needs of the clients there. So, what are some of the key considerations when setting up a private label? Now, I'll caveat this up front again. This comes from really the Netwealth experience in terms of offering managed accounts through a managed investment scheme structure, where we are the responsible entity. So, ultimately, we are very tightly regulated by APRA as an RE to issue an offer document or a PDS in the marketplace and appoint an investment manager. So really, there is a fair bit of governance oversight and overlay, but starting with from the business viewpoint and the benefits that the businesses are looking for, I guess we've already touched on a number of these points, and it's around the efficiency and administration. It's around implementing that investment value proposition. It's tailoring then the advice more to the investment value proposition and segmenting the client base. The advice tech report we released earlier this year, though, was quite interesting. That clearly improved efficiency at the advice level is the main driver behind advice groups looking at using managed accounts. And then you'll move down to a number of, I guess, what is perceived to be smaller benefits, better trading, probably getting back to that efficiency and treating clients fairly, better client engagement in terms of transparency in the portfolios, and really then driving a better client understanding about what's in the portfolio, tax outcomes at the edges, and as an additional revenue stream, it's quite low there. But I will caveat that additional revenue stream must be commensurate with the role that each model manager would be playing to be appointed as a manager. So just briefly touching on what advice groups really need to run a private label. I think if I was an advice group and I'm thinking about using managed accounts and looking at the various platforms in the marketplace, my whole starting point is what in-house skills do we currently have to run our model portfolios? Do we have, strong investment governance? Do we have a structured investment committee? Do we have our own asset allocation model? Do we have capital markets inputs and an optimizer? Or are we using an external expert in asset allocation? How are we selecting the underlying securities or the underlying funds? So really, I think, you need to look and think about the different platforms, and I guess what we view as you've certainly got to work in very much a consultative manner with your prospect clients in talking about what can and can't be done, in assisting them in getting their governance up to the standards to be able to offer a managed model. So you've really got to go through and look at what you wish to offer, and then can that managed account capability implemented efficiently? is the platform robust and scalable? Back to my earlier comment there are some platforms just releasing managed accounts into the market. There are others that have been offering it for 5 years plus. So you really need to understand if it's embedded as part of their normal scalable administration or if it's a bespoke offer. You need to have a rigorous request for proposal to identify what's going to be the appropriate administration service. Um, and I would suggest that you also need to look at a platform that has a strong emphasis on governance and compliance. Pleasingly, a couple of prospect clients, after they chose to go with Netwealth, they said one of the main considerations was our level and view on governance and compliance, because they said clearly we are going into partnership with a third party, and we want to make sure that there is going to be nothing that can potentially tarnish our brand in terms of working with this key third party. So really, in terms of the platform considerations there, you've got to really look through if it's got the genuine systems. You've got to think about the investment options. Are they a genuine non-conflicted investment universe, or are they a more restricted universe that a platform is offering, but the platform may also have in-house asset management capabilities? What are the underlying assets can you use in your models? Can you use a selection of equity SMAs, managed funds, direct ASX listed assets, international equities? What level of customization, i.e. IMA functionality, does the platform offer? And pending the type of clients that you have, the more need that you will probably have for IMA functionality. What's the performance reporting like? Is it transparent on the model? Is it transparent at the client account level? Is it cost effective? How does the trading work? Can the managed account provider offer it within super, within IDPS? Will the managed account provider also work with you to ensure that there's an appropriate investment minimum amount set on each SMA? And really, that's a key point, because you need to ensure again that whatever model you're providing, the underlying client, when they invest, has minimal tracking error to that model. So typically, the larger the number of underlying securities, the larger the minimum investment would be to make sure that that model is appropriate. And then the last point is the lower risk legal structure that can be easily explained to clients. So again, reiterating, most of the SMAs offered by platforms are offered through managed investment schemes with a responsible entity who is legally responsible for issuing that investment into the marketplace. Couple of quick comments on investment considerations. So really, I've made the point already around the RE issuing the managed investment scheme. It's highly regulated, so the RE really needs to document each manager that they appoint. The RE's got to document who is the business, who are the key people, how are the decisions made, who are the members of the investment committee. Do the members have the appropriate skill set matched to the portfolios that are being offered? And if not, are there external third-party researchers, consultants assisting? Is there appropriate governance in place? Is there a lot in the way of investment administration? We've got a number of clients running direct equity portfolios. The more you run in direct equities, typically the more you bump into corporate actions. And we find that there is significant amount of dialogue that's required between the manager and Netwealth to ensure that the corporate action is appropriately addressed. You've got to think about the type of licensing required. How is that managed account being offered? Again, back to my earlier comments, through an MDA, through an SMA, through the asset class order or the MIS. And then finally, thinking about the compliance, resourcing and the processes in place, both at the model manager and at the platform. So in terms of determining what is needed there, I think this is fairly, well understood in the market. But for Netwealth to appoint a manager, we need to document in writing, as per APRA regulations on an RE, the detailed investment philosophy, a detailed process. How does the asset allocation work? risk management. We must document the investment mandates and the profiles. We've got to do a business review. We've got to understand an operational due diligence. We've got to look at the systems and the processes of the manager, the investment committee, the governance really, and really, I guess, also looking at compliance, conflict of interest policies. You know, in terms of an investment committee, is there an independent chair? Is there an appropriate check and balance that's actually used there? Um, and I guess really from our experience is that for most of the private wealth groups that are running their own model portfolios in a number of SMAs, I think we have one client who is doing most of it in-house, and they are spending a significant amount of money, well over $1 million, on a chief investment officer, on a couple of analysts, on the Bloomberg screen, on the investment models they've built. But most of our clients are using a combination of their own internal expertise and potentially an asset allocation expert, a research expert to give the view on ETFs or on managed funds. And then at the other end of the extreme, we have a couple of private wealth groups who have badged up a professional manager's set of SMAs or managed models. So again, as a private wealth group, you really need to think about how much you wish to invest, what type of resourcing you can devote to it, and how you would use third parties as well to ensure that you have an investment grade private label. So to finish there. Managed accounts have come a hell of a long way from the origins in the US in the late 1980s. A managed account service is purely about the technology provider. It's not about a platform really packaging up and trying to distribute investment management capabilities. It's about offering genuine administration services. As an advice group, do you have a very detailed investment value proposition documented? You then need to undertake detailed analysis on the platforms to understand their capabilities, their functionalities, their scalability. And you've got to ensure that functionality is appropriate to what you are trying to achieve back to your investment value proposition. Naturally, you need your philosophy, your process, your risk management, etc., all documented in detail. And then you need to consider what investment management role you want to play, what resourcing you wish to invest, what's your skill sets, and where you'll party with third-party providers. So at that, I will finish up, and I thank you. I think at this stage we're going to throw it open for questions.
Questions. Yeah, look, thank you very much, Paul. And we've had a number of questions come in, and if you're out there listening and you've got questions that have come up from Paul's commentary or just generally about managed accounts, feel free to send them in. So look, here's the first one, Matt. It concerns the point you made about bonds, Paul, and it's one I think is particularly interesting. How do you see advisors using bonds or perhaps derivative overlays in managed account portfolios?
Yeah, well, I think there's a few things there. I think naturally we've seen a increase in the amount of listed income that's issued on the ASX, so it's sort of created a larger universe. Sometimes I guess it's questionable the quality of that listed income. i.e. the credit that is offered there. We are now also seeing through Austraclear the ability to buy $100 parcels of Australian government bonds. So you can get an exposure to an Australian government bond. We're also dealing, and we've just started doing it for a couple of groups, in terms of administering over-the-counter bonds. And a couple of the larger banks are now looking at how they can actually securitise those bonds into a sort of more manageable portion for the mass advice market. So we're seeing an increase in opportunity there. Sorry, Toby.
And do you see those being? Well, I was going to say, do you see those being offered as sort of hold to maturity type structures, or actively managed in managed accounts portfolios?
Yeah, well, I would have thought typically they are actively managed in the managed account. I guess the our experience is that a lot of the listed bonds that are administered on our platform are held to maturity. They are not actively traded. Um, but within the managed account structure, and again, it gets back to understanding how they're being used in a portfolio there. But is there a professional manager looking at the credit quality? Is there a manager looking at duration and the duration exposure in that part of the portfolio? So it gets back to the value proposition there. Um, just to briefly touch on again the use of derivatives. As I mentioned, I think there's a couple of ETFs on the market that allow you to short the market, that allow you to short the US market. But I've also had some discussions with a fund manager about doing a currency overlay on a unit trust where effectively you wouldn't even have to invest anything. You would just commit X amount of units, and then at the expiry of the contract, the derivative contract over the currency, you would then be either required to pay up or you would receive a benefit that would offset the movement in your total global equities portfolio. So we're seeing it arrive and starting to come into, I guess, more mainstream. I think we're probably a little way off applying for derivative contracts ourselves and derivative licensing ourselves and implementing it. But I think there are more vehicles getting out there in the market that that advisors can consider using.
Yeah. Now you touched briefly on fees. I know it's an area that interests me. I've seen a number of fee models. Do you think that the main fee model that's being used at the moment is kind of an advice fee plus a managed account fee or SMA fee plus a platform fee? Do you see, significant movement away from that kind of plus the underlying ICRs from that kind of tiered wedding cake structure?
Yeah, I think so there, Toby. I mean, I'll be honest. One of the closest things that we are focused on when we are proving I guess a private wealth group's portfolios to be run in an SMA, is I need to justify to the board of Netwealth why that fee is being paid and what the different players are doing to get that fee. So firstly, is it equitable? To your comment around changes there, I have been surprised in terms of probably the last 3 good prospect clients we've been talking with, they don't want to charge any fee on the model because they are actually got it embedded in the advice.
Yeah, and I think that sort of speaks to the best interest issue, doesn't it?
Absolutely.
Sort of the heightened awareness of best interest and the sort of perception that ASIC thinks best interest is equated with same or lower cost. Yes. What about? There's a question here. What minimum FUA or FUM do you suggest is needed to make a managed account structure worthwhile? And I might attack that in 2 ways. One is at the aggregate program level. So if you're an advisor wanting to go down the path of your own portfolio, what does Netwealth have a sort of threshold? And I guess then the second way of viewing that is at an individual account level.
Yeah.
Do you have views on those?
I mean, yeah, certainly Netwealth does have a view, I guess, on the funds under management expectation. It's a little bit different though, because you've got to look at it as a platform in totality of the relationship with the advice group. So whilst some advice groups may be, very strongly putting most of their clients into the managed accounts, some other advice groups are very broadly using the platform and they're just using the managed account at the edge. So we've got to look at the totality of the relationship there, notwithstanding that,
You'll take all comers so long as they've got money.
We'll take all comers, correct there. But no, in all honesty, there is a lot of work in terms of the review, getting it approved, working with the private wealth groups. I estimate that, my team would spend up to 2 weeks full time over maybe a 2-month period, 3-month period, dealing with the various advice groups to get it set up. So it's not so, and then we issue a PDS in the marketplace, and then we need to set up the models on our systems, and we need to set up the mandate monitoring, etc. So it's really something that I think there needs to be some level of scale. And also for the time commitment for the advice group to sort of go through the DD process with us. It's not something that they typically are going to want to go through for a $10 million, to run 10 million clients or so in a
and just to the second part of that question, then, so do you have a view as to what the minimum per account balance is likely to be? And I guess that's a function of whether it's managed funds or direct securities.
Yeah, I mean, what an investment minimum is on a model, or what the average client sort of is investing.
Effectively the investment minimum on a model.
Yeah, well, they're going to vary. I mean, typically on Australian equities, they're usually more constrained. We think around $25,000. Pending, you really need to understand what is the maximum amount of securities the model manager may typically want to hold at an extreme point in time, and what's their trading behaviour. Are they trading small slices, and like typically a managed fund would? So I find with a lot of the fund managers, you really need to talk to them in detail that this is not a managed fund. We're not building a position over time, because you put in those small amounts of trades, and on a lot of the platforms it won't meet the minimum cash requirement for the trade to actually be implemented. So you've got to understand all around their trading behaviour, the number of securities. Typically then we've found with global equities, and one of the issues with global equities is the simple price of a mega cap stock in New York. So you look at the New York Stock Exchange,
that's right.
You look at Priceline, I think it's about $2,500 for one share. So if a manager's got a mandate and they want to own 1% as a minimum in a stock, well, potentially you're then looking at 250,000 as a minimum to appropriately offer that model in the marketplace, knowing that the underlying investors will have very low tracking error of what they're holding compared to the model. So it's really dealing with the managers and understanding and working through those issues.
And a final question to wrap up. There's a question here which says platforms are primarily used by advisors. Do you have any capacity for direct retail investors to access a platform and to access the SMA function services?
Yeah. Well, I mean, ultimately, I think we're at the stage we've got a little over 100 SMAs that we're administering for private wealth groups. We've got about 30 odd on a public menu, and that's soon to go to 40 in the short term. So our direct platform investors, and I think on our IDPS platform, we have almost 15% of our investors are direct, they're non-advised. They get full access to the to that public menu, and there are some diversified managers there that are using managed funds. There's diversified managers just using ETFs and direct equities. And we are also quite, in terms of, I guess, focused on providing education ongoing out into the market about what managed accounts are, what they mean. So those direct investors do get access to the public menu of SMAs.
Great. Okay. Look, thanks very much. So, Paul, thank you very much for your presentation today. It's been a pleasure for IMAP to have you as a presenter, and thank you to Netwealth. So, just to those who are listening, I'd encourage you to participate in the awards and to see what best practice looks like. So, thank you very much, one and all, for coming along.
Thank you very much, Toby.
We'll talk to you again. All right. See you, Paul. Bye-bye.